Good morning, everybody, and welcome to our monthly webinar. And this month, we're looking at the selection of appropriate accounting policies. It's a continuation of last month's session, and the focus in particular aligning with the organization's stage of life. Now, this is something that's really the brainchild of Kevin. So, Kevin, welcome and thank you for presenting this today.
Thank you, Aletta, and good morning, everybody, and welcome to today's session. It's so good to see you all. I'm looking forward to actually completing this little journey we've been on when it comes to accounting policies. There's some good messages in this today, so let's get started, I think.
All right, thank you, Kevin. Maybe before we move on, so the agenda that we've put together, Kevin will do a little bit of a recap on what we've covered in March and the basic principles we've laid out or discussed. Then he'll move on to an organization stage of life. He'll look at R&D activities. He'll also look at M&A activities. And then Ashley will talk about a focus on extractive. So we know we have a large number of clients in the extractive space, and therefore Ashley will focus on that. As you know, Ashley is based in Perth, where extractives is really their bread and butter. She's an IFRS partner and an audit partner, and therefore she'll talk to that. And I'll round out the session by talking about the impact of leases on the future and some of the decisions you could make or the things you could consider, the levers you can pull. I also wanted to remind you that next month we've got our very important webinar where we're looking at our half-yearly accounting standards update, getting ready for 30 June 2021. As you know, we do this usually in May, and then we do another one in November, getting ready for 31 December. So this webinar is definitely one to not miss. So just a reminder of that one, please register. The other thing is tomorrow we're launching our series of general purpose financial statement virtual workshops. And we're starting with business combinations on IFRS 3. We've got a series of 20. It's going to run every Thursday for 20 weeks. So 2 hours, an overview of these key accounting standards, overview, practical case studies. So if you want to register for that, it's not too late. Please do that. Also, many people have asked me, Aletta, I can't make this particular time of the virtual workshop, but very interested. So what we do is we provide all the materials and the recording to them. Kevin, I've even had requests for a number of people that are in very different time zones and they still want to attend these workshops. So they'll be looking at the recordings afterwards. So it's a very exciting thing to really have a look across all these accounting standards as we get ready for general purpose financial statements. And then the other thing that I thought I'll flag here is around financial education masterclasses. Now, over the next few weeks, Tanya Titman, who leads our whole financial education and also our innovation and growth area at BDO, will be running 3 masterclasses, one on knowing your numbers, another one on controlling your cash flow, and one on forecast your financials. And really, she's focusing on it's not the debits and the credits. It's every decision you make has a financial consequence. And therefore, to understand that financial consequence now and in the future. And then she also has a few alternatives that you can consider. There are online courses, there are one-day workshops, and there's a 12-month business growth program, which really looks at strategic decisions, impact on cash flow, profit and loss, social media, marketing, building a team, and that 12-month program is being presented in Brisbane, in Melbourne, in Sydney, in Perth, in Cairns, everywhere across Australia. And I'm personally presenting that program in Melbourne. So if you're interested in any of these free financial education masterclasses in the next few weeks, please go to the website and register or contact me. If you're interested in that 12-month business growth program, please reach out to Tanya or reach out to me. And I think the other thing in speaking to Tanya, this is not about just small, medium-sized entities wanting to improve financial literacy and grow their business. This is also sometimes operational people in a large organization that like to upskill their knowledge around financial aspects to make a better and a bigger contribution to the business. So there might be people in your organization that could benefit from this to better understand the impact of their decisions on financials. So I just wanted to flag that. Please reach out if you're looking for any further information. And obviously, there's a website with all the financial education stuff. Interesting that, Kevin and I have been on this journey for the last 5 years, looking at monthly webinars. Obviously, that are complimentary webinars. We've also launched virtual workshops. We've done AASB 16 or IFRS 16 masterclasses, and more we are seeing that people are looking for information to improve their business. So a real journey. Please join us and reach out if you want to connect or join any of those. Kevin, at this stage, I'll throw over to you to do a bit of a recap and the first part. Thank you very
Thanks.
much.
Thanks, Aletta. And a couple of comments. One is I couldn't believe when you put the slide up to talk about the half year or preparing for the half year or June. When did we get to May and June? When did that happen? I mean, 2021 is almost halfway done, and I think I'm still sort of typing 2020 in some of the dates when I'm actually typing emails. So it's almost like that, like 2020 didn't really happen. So that was the first comment. Second one is the virtual master classes or the virtual series of events that we're putting together. It is true. I'm getting more and more queries on very specific topics, and so I'd encourage everyone who's listening to go and have a look at the list. There are a couple on there that seem to be more popular than others, but that doesn't mean that the others aren't important. But on the 27th of May, for example, the IFRS transitioning to IFRS 1, I must have at least 4 or 5 requests a week on that topic. So that's clearly the hot topic of the future. And so I'll get into the recap. Now, I have to be honest, on the recap, I decided on Sunday this last weekend to actually listen to our webinar from last month, which was the basic alternatives for accounting. And it was the first time probably I'd actually heard my voice on a recording, because I'm not one to go back and listen to the recordings for no reason. So the first thing that happened was I was really surprised to hear what I sound like on a recording. And we won't say whether it was good or bad. I was just surprised. But I did actually listen to the session, and even though I was part of the session with Aletta and Ashley, it was amazing that I actually took different things out of the recording. So I'd encourage you to actually go back and listen to last month's recording on the basic alternatives to accounting policies, because even just on a re-listen of the recording, I actually took different messages out of it. So go back, recap some of that material if you have a time. But I have taken 2 or 3 slides out of that, which is what I'll recap with you now. And Aletta, you can move forward on it. And there was the slide of the session we did. It was on the 17th of March, but the recording is available on our website. Just click on listen to recording and off you'll go. But basically, here's the key messages we had last month. What are accounting policies? Now, very basic, high level, specific principles, bases, conventions, rules, and practices applied by an entity to prepare their financial statements. And look, I think we all get it. The concept of accounting policy is, to a degree, to faithfully represent transactions and events in your financial statements and to report that. How you represent your assets and liabilities and how you explain the performance of your organization. I think we all get that, but it really boils down to what's going to be income, what's going to be expense, what's going to be an asset, what's going to be a liability, and then a lot of it after is presentation in terms of cash flows and explaining it in terms of notes. assets, liabilities, income and expense. And I'm going to make reference to assets, liabilities, income and expense along the way today, but it's the faithful representation of those. So moving along to the common observations, this was one of the key slides that I dealt with last month, which was what do we commonly observe in accounting policies? And we touched on the idea that accounting policies are fluid. There are options. There are different ways of actually selecting policies to apply certain transactions. Some of them you're stuck with, but others you can actually develop accounting policies around. And that there is a strategy behind how some entities select accounting policies. And the three strategies we put on the table last month were a strategy that maximizes profit, and that would be very much an organization that's profit driven. I don't want to use the word short term because it sounds like long term isn't important, but short term profit representation. So a listed entity is very much driven, for example, by the EBITDA number, which needs to be reported on a half yearly or an annual basis or so forth. The capital maintenance strategy. Capital maintenance is a very old term. I will admit it's not actually a very, it's an old accounting concept, but it's the best I could come up with last month to actually represent the concept that accounting policies that are focused on asset and liabilities as opposed to performance and income is your second strategy. So those that maximize equity or maximize asset carrying amount, or maximize net asset carrying amount is your second strategy. And then the third strategy was no strategy at all. And I think I might have made some comment about something like 90% or 95% of the companies we see have no strategy when it comes to selecting accounting policy. That doesn't mean they're not selecting accounting policies. It just means that they're taking the ones that everybody else takes. So they're either using tax depreciation rates, or they're just preparing financial statements for a compliance-based purpose. So there really hasn't been much thought into, can I select an accounting policy that better suits my strategy? So those are the no strategy compliances. And of course, you then do get some that mix and match. You might have an organization that's preparing compliance accounts, and maybe for a particular accounting transaction, they choose a maximize profit strategy just for that transaction. But I mean, that's rare at the best of times. The last bullet point on that slide was actually about systems and data, and I'm going to come back to that as we move through to today, because whether you like it or not, sometimes your choice of accounting policy is dictated by what your data and your information system can produce. If you can't produce the information to support an accounting policy choice, sometimes it's just not a choice, and you kind of pushed back into the one that you can support with the information and the data. So those are sort of the commonly observed strategies. And then Aletta dealt with the next slide, but I'll run through it for her just in the interest of times. And during last month's session, she spoke about the basic alternatives across standards. So this is once you're in an accounting standard and you've kind of decided that particular standard applies, there are really sort of two, call it extremes to accounting: cost-based and fair value. And a cost-based accounting a policy choice very often is the one that drives a performance-driven strategy. So it's more focused on the income statement, whereas fair value is driven by maintaining your asset values and maximizing equity. But practical expedience, and Aletta, I'll probably give you a little bit of I'll own up to it. I perhaps maybe never appreciated how important practical expedience were to last month's webinar until I re-listened to it on this last weekend, because practical expedience, they are very relevant to a lot of the new standards we've seen. So revenue and leasing and insurance contracts, which are coming up. And the reason why those practical expedients exist is because most of the new accounting standards are being driven by the need to have data and information systems that can support those policy choices. And practical expedients, in a way, are designed to allow you to take the opportunity provided by some accounting policy choices where your systems and your data gathering may not quite be up to scratch, specifically historical information. But if you're going to choose an accounting policy that goes with a practical expedient on adoption, what you're actually signing up for is you're signing up for a commitment that you're going to get your data and systems up to scratch in the future. So be careful of practical expedients that are chosen as a short-term solution to a problem, and then you don't actually react to what that's telling you. And I'll give you an example. In the leasing standard, there were a multitude of practical expedients when the leasing standard was first adopted, and many of them were practical expedients which allowed you to choose an alternative to lease accounting where your historical information didn't support the policy, but there was an unwritten commitment in that choice, which was basically, yes, you can take this accounting policy. You don't have the information to support it in the past, but you're signing up to a commitment that going forward you will put data and systems in place to support that accounting policy choice. And a lot of organizations we've seen have actually not done that. And I'll give you a great example. And Aletta, here's a little bit of a sell. A lot of organizations chose accounting policy choices that maximized asset values on lease accounting, but they decided to use Excel to try and calculate them. And 2 or 3 years down the track, that Excel, the system, they can't support the accounting anymore with Excel. The Excel is not the Excel is not sophisticated enough to apply that accounting policy choice, and now they're running into problems. So things like choosing a portfolio discount rate for all your leases on transition, but now they're finding that every lease needs its own discount rate, and Excel doesn't support that. So it's a very good example of a policy choice you've chosen. The system can't support it. They're struggling to keep up. So just be careful with the alternatives across the standards, because choosing a practical expedient in the past is really a commitment that you're making to get your systems up to scratch to support its ongoing use. And maybe that's just the lesson that I took out of the re-listen from last month's recap. Now, Aletta, I can see you nodding your head. I sometimes know that means you want to add something. So would you like to just add something before I move on to today's section?
Yeah, Kevin, you are absolutely right. In the olden days, we only had accounting policy choices where we could make decisions. But now with these new practical expedients, there's so much more that we can think about. The other thing is to not forget about transitional requirements, because I think that absolutely fits in the bucket of, on the date of transition, to make transition easy, we give you a few shortcuts, and this whole special purpose to general purpose fall into that category. There's a lot of shortcuts. However, going forward, you're now playing, in the real world, big boys, you have to do general purpose financials, fix those systems and processes, and the shortcuts are over. So I think that's really important.
No, that's absolutely right. And funny enough, I know what you mean by olden days, but I will just like to say I never lived the olden days. I don't know what you're talking about. All right, so moving along then to today's section, we're going to be talking about organizational stage of life. And Aletta is correct. This is she does make reference to the fact that this was my topic, and what she means by that was, towards the end of last year, I realized that there was a tie-in between the stage of life of an organization and their policy choices and essentially their CFO cycle. So this topic was born out of a couple of experiences I had last year, and I wanted to show you what I mean by it, and I'll draw some of the lines this week. So the slide that's on the screen now is called Navigating the Business Life Cycle. It's actually from a publication out of our private equity group. So this is out of our corporate finance team, although some of those that are kind of linked to the private equity corporate finance teams. So it is a publication that's available on there, and it's a little bit of a capability statement that the corporate finance team has, but it's out of that publication that I've actually extracted this diagram, this life cycle diagram, which will be on the next slide. So the next slide then is the organizational life cycle, and really I'm going to be referring to a couple of points here. Now you can go on the internet and you'll find many different types of life cycle organizational charts, but this is the one I'm going to use for today's session, which really says you start out as an organization at the beginning, and then you start to go growth and funding, and then very quickly you start to expand up to hitting some challenges, and then ultimately extracting cash and realizing value. Now, different entities will have different years to this. I mean, some organizations, this life cycle will stretch over 30, 40 years, whereas other life cycle will be much shorter, 2 or 5 years, depending on the, whether you're software development or certain types of industries and sectors. But I'm going to focus on a couple of points here today, because the way I want to demonstrate the point I'm trying to get across about aligning accounting policy is actually to try and align the choice of accounting policy with some of these life cycle stages, but mostly trying to talk about where these life cycles are quite close together. Because when your life cycle is spread over a long period of time, to a degree, it almost doesn't matter when you choose your accounting policies, because you've got time to recover from poor choices. If you choose an accounting policy choice which was maybe not the right one at a particular stage in your life cycle, but your next stage in the life cycle is 10 years away, you've got time to fix that. You can fix it by either changing your policy and doing restatements, or actually, putting new systems in to replace it. But if your expanding stage and your realizing value stage are 2 or 3 years apart, you don't have a lot of time to react to a choice of policy that doesn't suit you. And so I've decided to try and demonstrate that concept with two topics. Two topics. It'll be, at least from my point of view, it'll be research and development and mergers and acquisition. I know Aletta will be talking about leases later on. And hello, Ashley, I see you've joined us. You'll be talking about extractive in a moment. But the very
Good
specific points that
morning.
I'll be drawing out, morning, Ashley, the very specific points that I'll be drawing out today will be when your expanding stage and your realizing value stage are quite close together. And we are seeing that with let's say software development company or startup companies which have an intangible type product. So very often it's software, where they're in the growth phase. They may be going through a bit of a merger acquisition. They're getting financing from an external source, but at the same time, they're looking at an IPO to actually as their exit strategy in 2 or 3 years' time. That means they've got a very short life cycle left, and their accounting policies need to tie up. And really, what happens here, very quickly from an accounting point of view, if you start on the left-hand side of the diagram, most organizations on the left-hand side who are starting out are focused on profit. Whereas at the realizing value stage, they are actually focused on asset value, because you can't go for, let's say, an IPO to realize your value or to exit strategy and you've got nothing on your balance sheet. Because if there's nothing on your balance sheet, what are you going to market with? The IPO suddenly has a zero balance sheet. And that is often reflective of the fact that you haven't moved your accounting policies along with it. So I'm going to be talking today about a very short life cycle between expanding and realizing, but also focused on the idea that you're actually moving towards an asset protection strategy where you're trying to keep the assets on your balance sheet and maximize that, because obviously your future um, message as an organization is wrapped up in your asset balance sheet, whereas your performance or past is wrapped up in your income statement. This is also linked to the role of the CFO, which is the next slide I have. Now, this little wheel is the most complicated wheel you'll ever see. It's nice and pretty, and it's got all the nice colors on it. It comes from it's a Belgium. It's actually come from BDO Belgium. It's also just a version of a CFO role, and there are various versions of these floating around. But the reason why I chose this one is, one, it was BDO specific, but also this particular wheel that deals with the office of the CFO actually links my message really clear in the way that the various components of each part of the wheel actually integrate. And let's see, if you jump to the next slide, I've magnified it, because the part I'm going to be talking about today is the blue and the gray bit. And that's actually value protection and technology management, because that's really the message I've been trying to draw out here. Now, when we think of accounting systems and reporting, most organizations in the life cycle start with compliance, which is, you can see there in the gray bit, there's a compliance wheel. And that is, I've got to prepare financials for a compliance purpose. I've got to lodge them with ASIC or whatever it may be. As you start to move through your life cycle and you start to go through growth and funding and expanding, there'll be a couple of transactions. So there'll be transaction execution. So you'll see compliance and transaction execution start to interact. The reason why this wheel is the one the CFO wheel is the one I've chosen, is because in actual fact, the blue bit interacts with the gray bit, and they actually interact with each other as you move from the center out. So these concepts of reliability, scalability, and automation, they're actually positioned where they are for a reason. The more you move from, and I'll take the blue bit, the technology management, the more you move to the left of the wheel in the blue bit, so reliability, scalability, automation, it's actually, you need to move that way to achieve the bits in the gray bit. So in other words, to do transaction execution, be in the gray bit, you need reliable information. But if you move towards asset protection, which is further along on the gray bit, you actually need more automation on the technology side. So you can see it opens up like that. You can see my hands. And that is actually what the accounting policy aligns the same way. If you've got an asset protection strategy as part of your value protection strategy as a CFO, your systems need to be more reliable, scalable, and automated, and even more secure. So that's really how this wheel works. And it's the same with accounting policies. If you are adopting an accounting policy that is designed around asset protection, which is really designed around asset maximization on the balance sheet, your systems and processes actually need to support it by not only being reliable, but scalable and automated. And that's what the wheel does. And it's the same with the accounting policy choice. If you're going to choose an accounting policy that maximizes asset maximization, your systems need to support it. And if it doesn't, you're going to run into trouble. And maybe at that point, the webinar is over, because that's really the key message of the whole session today is, in order to actually choose accounting policies that align with the organizational life cycle, which really aligns with asset protection on the balance sheet, you've got to make sure your systems and processes and technology are keeping up behind it. Otherwise, you really don't have much hope of actually achieving that. And the best way to do that is actually to give you a couple of examples. And I've chosen, as I said, R&D activities, and I've chosen merger and acquisition. So let's jump into R&D activities. Now, I'm very fortunate because yesterday, Aletta actually participated in and unless I'm going to get this wrong, but I think it was an R&D tax incentive virtual webinar. Did I get that right?
Yes, we did a virtual workshop with an R&D partner.
And that is available. It is available online. I'm going to say so. I haven't attended it, so the reason why I'm tiptoeing around it is because Aletta and I, although we appear joined at the hips, we don't always do everything together. And so yesterday she did it by herself, and I haven't actually watched the entire content, but I did take this slide out of that material, and this was the R&D activities. Now, this is designed mostly around maximizing R&D tax incentive claims, really the incentive of government, which is administered through the ATO system in Australia, to essentially take advantage of R&D tax incentive claims. So this slide comes from that. So this is not actually an accounting policy slide. This is a slide that's designed around, are you developing or a new or improved product, process, or service, moving through to, are you trying to be involved in a technical problem that you're trying to solve, all the way through to will you be able to have the knowledge and so forth to solve it? And you can see me tripping over the language because there's a little bit of a tax side, or it's a bit of an R&D slide for those who are involved in the R&D tax incentive. But ultimately, organizations who are in the growth and funding phase of their life cycle will often take advantage of the R&D tax incentive in order to some degree actually just maximize cash flow, because this can actually improve a company's cash flow. But very often, if you actually performing R&D activities, you're in a growth and funding phase, you're maximizing either the incentive from government or the cash flow from government. That's great, and we've got wonderful people in the organization who can assist you with that. However, what's often lost is the fact that there's a next step to it, and the next step is, what about accounting for that? Because the accounting for that often gets lost by the wayside because it's not important at the time. And it's true. And let's, if you jump, I think I actually do have. Do I have there we go, the organizational life cycle again, just to draw it back to this slide. You can take the R&D incentive at any stage in your life cycle. I mean, there's advantages at any point along this route, but often the growth and funding and expanding stages, is where it very often becomes a key feature of the organization's strategy, to maximize whether it be funding or support from government for a new incentive. The thing is, if you're heading towards your realizing value stage really quickly, and what I mean by realizing value is an exit strategy, you want to make sure you also maximize the R&D on your balance sheet. You want to make sure you extract the value of your R&D activities onto your balance sheet. And we do get referred to by some of our tax guys when they can spot this coming. So they'll get a client who will come through and they'll work with them on an R&D tax incentive, and they'll say something along the lines of, "What's your exit strategy?" And they'll say, "We want to IPO in 2 years' time." And at that point, our R&D guys will say to them, "Well, why don't you also maximize the asset value that comes from R&D activities at that stage?" And how do you do that? Well, you just take the next step, which is build an asset strategy which can capitalize your development activities and put them on your balance sheet, because once it's on your balance sheet, you can align your accounting policy to your life cycle. And this is where R&D cost capitalization policies come in. And Aletta, I think it's my last slide, if you don't mind moving along. The problem is
Evan,
is that the yeah
sorry, if I could just maybe
yes
add, we've done this webinar or this virtual workshop yesterday with R&D and a whole 2 hours. And one of the fascinating things there um, is there's such a very interesting interplay between income tax treatment and whether you can get deductions for tax purposes. Then, quite separate to that, whether you can get this R&D incentive, actual
mhm,
cash, or it could maybe reduce your tax bill, or you get actual hard cold cash, and then accounting for it. And then you get to that point on, if it's research that's being expensed,
yeah
um, your government grant, your incentive slash government grant is booked in your P&L immediately. However, if you capitalize that incentive, and you've got an intangible asset in your books, you still get the cash, you still get the tax deduction, but for accounting purposes, you put the asset on the balance sheet. It means your P&L looks a bit worse because the government grant is now pushed to the future,
to the
right?
future.
Because government grants still have the old-fashioned, and I know you don't like the word old, but I'll say old-fashioned matching concept. Um, so again, it comes back to your strategies. Do you want to focus on the P&L, or do you want to focus on that strong balance sheet? So actually, during the virtual workshop yesterday, I was seeing the connection clearer and clearer as we go along. So
Yeah,
I
and
hope
that's it.
that
And
fits into your
well,
example.
it absolutely does. Because what you're really saying is sometimes there's a bit of short-term gain, so short-term pain for long-term gain. And that's kind of what I'm saying. Yeah, because if your immediate strategy or your short-term strategy is to maximize your asset base in order to, let's say, either extract more cash or realize value, let's say through an IPO at the end of this life cycle, there's going to be a bit of performance short-term pain in your income statement, but the longer term payoff will be in the asset side of it. And that's I mean, it's actually the best example of aligning not only tax and government grant, but also asset and life cycle strategy. This is the best example of how they all come together. But if you're focused only on the income statement as a CFO in terms of performance, you might just miss the asset long-term strategy, the longer-term gain. And it boils down to the next slide, and I hope it's there in the order. It's the R&D cost capitalization, because this is essentially the last thing you need to consider in the thing we've been talking about. Aletta was talking about ATO, tax, R&D incentive, government grant accounting, and the R&D cost capitalization is very much the last thing in the chain, because it's ultimately the last thing in the in the company life cycle as well, and that is to maximize asset value creation. And how do you do that? You design a cost capitalization strategy that maximizes the asset value, because obviously that's going to serve you well down the track. Because we know with R&D, and I don't think there should be anybody that's on today's webinar that probably doesn't know this, but if you don't have a formal cost capitalization strategy for accounting, all your R&D expense is just that, an expense. But if you've got a formal cost capitalization policy, then at least the development phase of your R&D gets to be capitalized as an intangible asset. But if you don't have that in place, it's all assumed to be expensed. And
And Kevin, I listened very carefully yesterday to one of our tax partners, R&D tax partner, and I know also to get this R&D incentive, there's a lot of steps. You have to be registered with Oz Industry, etc. But the key message that he had yesterday was around documentation. You have to document your
well done.
timesheets. You have to prove why this is research and there's fancy definitions, etc. But ultimately, you have to prove the time and the cost you've spent on this research activity.
That's
And
right.
that is exactly what you and I would be looking for if we want to capitalize an asset on the balance sheet. So it was really
That's right.
fascinating.
And that's what the word demonstrates. So when you look at the development phase of R&D cost capitalization, and you won't believe it, Aletta, but I pulled this slide from a video presentation, which I think might be something like 11 years old. And the reason for that is because this has not changed in accounting standards for a very long time. In fact, I don't think there's been an amendment to the international to the intangible asset standard, other than perhaps some consequential amendments because of other standards changing. But you can see there on the development phase side of the slide, it says you can recognize the cost of the intangible asset so long as it demonstrates. And how do you demonstrate? Well, written documentation is the best way to demonstrate. And there's a couple of things there: technical feasibility, intention to complete, and so forth. The one key thing I will point out is, and this is a key difference between the tax and the government incentives, is that the accounting standards draw a line between research and development, whereas not so much in the research and development tax incentive, because as long as it's all within research and development, there's benefits from a tax or from an incentive point of view. But from a cost capitalization point of view, there's a very clear distinction between the R, the research phase, and the D, the development phase. And if you don't draw that distinction and at least achieve that point in time, shall we say, you don't get to capitalize anything. So if you've done all the work for the R&D tax incentive, go just a little bit further and put the necessary documentation in place to do the accounting R&D, so you can extract this value on the asset side of your balance sheet, down the track. Look, I mean, I think we'll leave it at there. I think we've probably demonstrated it enough. And you can see as well, Aletta and I and Ashley, we're on this great mission in life to actually integrate accounting with tax and government grant accounting. And if you haven't realized that Aletta talks every month about some other type of service line, and that's because it all fits together. And the best value extraction that we can take out of this is to actually bring them all together. And that's the same with mergers and acquisitions. So I'll jump straight into mergers and acquisitions. And you'll notice that I'm talking about it as an merger and acquisition. I sound like I'm from corporate finance. Instead of us talking business combination, IFRS or AASB3, I've called it merger and acquisition, because that's what this is. Merger and acquisition is a business combination. We'll refer to it in accounting world as a business combination, but very often it comes to the CFO as an M&A transaction, as a merger and acquisition. And back to my little fancy wheel, we're back to the transaction execution phase again. So we're executing on a merger and acquisition transaction. And once again, we want to try and protect the asset on the right-hand side of that, the asset protection strategy on the right-hand side over the long term. And the way that the asset protection side of the strategy often works from merger and acquisitions is through goodwill. Most M&As or business combinations will give rise to goodwill at some point, but goodwill is an asset that needs protecting just like every other asset. And how do you protect the carrying amount of your goodwill? So on the next slide, I've actually pulled the general execution of a merger and acquisition, which is your sort of day one accounting, and most of those of you who've been through a merger and acquisition or business combination, you'll know what I mean by purchase price allocation, where you've got to get a valuation of all the assets acquired, less the consideration that you've paid, and then the difference gives you the goodwill number. And that's so-called day one accounting for an M&A. But where we go wrong in terms of asset life cycle, asset protection, and company life cycle is no one worries about what happens next, which is day two. How do you account for it the next day? And most organizations will work the goodwill out, record the goodwill, and they won't worry about it until the next year end, when now they've got to do an impairment test and they've got to try and justify the carrying amount of the impairment. The thing with goodwill, if you're in your life cycle and you're focused on an asset protection strategy, there's actually a formal way to protect goodwill and its carrying amount, and that is to have an appreciation for what's called the Goodwill Lifecycle. Now, this is a brand new slide. We've never shown you this ever in any of our webinars on this, but this is what's called the Goodwill Lifecycle. This comes from a BDO publication which was reissued recently. It was the impairment publication, and it actually talks about the Goodwill Lifecycle. It is available under the IFRS publications section of the BDO website. And it really just takes you through what's called the Goodwill life cycle. And if you're a CFO aiming to protect the asset values of your balance sheet, for the long term, it's actually managing this life cycle that maximizes the benefit. And it really goes something like this. Your goodwill arises on an acquisition in the first stage. Day one, you allocate it to a cash generating unit, and then you manage it through the life cycle. But the one I want to talk about is the very first part of this life cycle strategy, which is allocating the goodwill to a cash generating unit. Almost all organizations who come to me with a goodwill problem have not managed the very first step in this life cycle, which is allocating goodwill to the cash generating unit. Most of them don't manage that at all. They just go right past it. And if you don't get the allocation of the goodwill to the correct CGU on the very first day, you most likely will fail in your management of that asset protection strategy. And I'll give you an example, and I try to make this as simple as possible. And let's say, if you don't mind jumping, I think it's 2 slides to the actual example. That's the example there. A very basic example on how do you manage the goodwill life cycle and protect the asset value of goodwill. Company A purchased company B. I just want to move this slide. Company A purchases Company B, a business. From this purchase, Company A is expecting cost synergies between Company A and another of Company A's divisions, Division Z. Most organizations who have not thought this through will tell you that all the goodwill belongs to Company B, because Company B is the entity we've acquired. So what they will do is they will say the goodwill belongs to Company B, and when they come to doing impairment testing, they will try and impairment test the goodwill and justify its existence by assigning it to Company B. Now, on the next slide, you will see what is the very basic discounted cash flow method we use. So this is what a basic discounted cash flow method. This is what most impairment tests look like. You've got a 5-year forecast period with a terminal period discounted back to a present value, the so-called enterprise value. And this enterprise value is the present value of the CGU cash flows. Now, Aletta, if you don't mind going back one slide, because I actually didn't put these into a nice format. So as you can see, Aletta is my slide navigator today. She's doing a great job. I didn't really put these into the best possible order, so she's having to keep on top of my idiosyncrasies when it comes to trying to navigate it. But going back to my example, if all of the goodwill is assigned to Company B because it was the entity that was the acquiree, you almost have no chance of justifying the ongoing carrying amount of the goodwill. Why? Because the benefit of the business combination didn't all belong to Company B. Some of it belonged to Division Z, because in this example, Division Z was going to also benefit from this acquisition because there were going to be cost synergies. So actually, some of the goodwill belongs to Division Z, not all of it to Company B. So if you haven't assigned some of the goodwill for impairment testing to Division Z, what's going to happen is you're going to write half of it off in the first year because Company B's discounted cash flow won't be able to support it. But if you allocate it correctly between Division Z and Company B on the very first day, and let's say you give half to Division Z and half to Company B, then those two cash generating units, Division Z and Company B, their individual discounted cash flow models can support that goodwill going forward. That's a basic strategy to maintain the carrying amount of goodwill going forward. And I have seen this time and time again, where some entities, they allocate the goodwill wrong, or they just don't allocate it. They don't even think about allocating it. They just say it all belongs to Company B. And the very first impairment test, the discounted cash flow model can't support the goodwill anymore. And as you know, once goodwill's written off, it's gone. Whereas if you just allocated it correctly on the very first day, you could actually extend the life of that goodwill for years into the future, lining it up with your life cycle, your asset protection strategy. At that point, I'm going to say to you, I'm going to leave you today. Don't forget the day one management. I'm going to hand over now to the extractives, which is Ashley. She's waiting very patiently there. But those are just two very, very simple ways of aligning your asset protection strategies with your life cycle stage. And in summary, R&D, goodwill allocation, everybody's happy.
Kevin, I think the key thing here is, and that's why you are right, you've caught me out and called me out. I am trying more and more to work with our fellow partners in tax, in R&D, in corporate finance. And the reason for that is by the time the clients come to us, you know, the damage has been done
That's right.
because all the structuring happened to achieve tax outcomes or legal outcomes, asset protection outcomes, etc. But nobody considered the accounting outcomes and the consequential impairment testing, etc. So,
That's
in
right.
a way, we are trying to say, guys, tell us about what you do, tell us what's important to you. Let's try and find similarities and say, oh, you interested in documenting? Oh, I'm also interested in documenting. Oh, you interested in identifying and maximizing goodwill, but I want to protect that goodwill. So I think it's a really interesting journey. We have to bring it together because the people who attend our webinars are CFOs who look at a whole of business,
That's right.
and our clients who speak to us have a whole of business approach, right? So it's kind of a logical next step. Ashley, you're so patient. We'll hand over to your wisdom and experience around extractives, and Kevin and
All
I will mute ourselves.
right, thank you. Sorry, I missed the start of the session, but from where I joined, Kevin, you were talking about the importance of selecting accounting policies to align with each entity's strategy, and a lot of what you've just spoken about is very relevant to what I wanted to discuss today. So I'll get started. Aletta, if you can move on to the next slide. So here we've got AASB 6. So in many ways, this is a very unique standard. It's industry specific. It actually has a couple of concepts that are outside the conceptual framework. It contains special rules for impairment, and it also includes an exemption from certain requirements of IAS 8, which links back to what Kevin was talking about before. When you're looking at transition, this can be a handy shortcut. So the effect of the exemption means that an entity is not required to look at other standards and interpretations that deal with similar issues or the guidance in the conceptual framework, and instead it allows entities to develop their own accounting policies under AASB 6 or use the guidance issued by other standard setters. As such, if you're in the E&E phase of your life cycle, it's critical to understand the different accounting policies and choices that are available, as they can impact your future operating results. So moving on to the first accounting policy choice, which is to capitalise or not to capitalise. So here I'm showing the decision to capitalise or not to capitalise your exploration and evaluation expenditure should be at the forefront of your mind each reporting season. So initially we see many entities are drawn to the choice to capitalise these costs with the view of increasing their asset values. However, the carrying amount of capitalised E&E has no relationship to the quality of a project or the ore body that's being evaluated. And if a policy of capitalising E&E is adopted, it can have significant downside with little benefit from an accounting point of view. So firstly, as shown on the graphic on this slide, if you capitalise E&E, you are continuously faced with the question of whether your E&E assets are impaired. So the last grey box on this slide, it should actually say impairment assessment is required at least at each reporting period. So I just missed out the at least part, which I'll talk about in a bit more later. But if you do, at each reporting period, if you do have impairment indicators and then impairment testing is required, this signals bad news to the market and could actually result in poorer share price performance than if you initially adopted a policy of expensing E&E costs as they're incurred. Also linked to what Aletta was talking about earlier with R&D, if your E&E asset is capitalised, then any R&D incentive that you receive will be hidden in the asset value rather than being reflected in the P&L. The third downside of capitalising is that when you move to the development phase, you must test any capitalised E&E for impairment. So this is where I'm saying it's at least at each reporting date, but also as you're moving through your life cycle, you need to do the tests again. And this incurs both time and costs, and any potential impairment write-downs would again signal bad news, which, you know, as you're moving through to the development phase, you're often attempting to raise capital here, so you would want to avoid any bad news to the market. And then finally, when the entity does go into production, and now this is the point where shareholders are interested in profit and earnings per share, if you have E&E that's been capitalised, this will be amortised to the P&L at this point in time, which can diminish your gross margins. So as shown by the simplicity in the green box, expensing E&E as incurred is an acceptable accounting policy and offers a lot of benefits for the entity and for future performance. And also it's perfectly acceptable to change your accounting policy from capitalising E&E spend to expensing it. So in line with what Kevin mentioned earlier, as you're moving through your life cycle, getting closer to the production phase, you may realise that you actually don't want to have the high exploration costs impacting your future profits. So at this point, you can do a restatement and change your accounting policy to expense these costs. However, you can't do it the other way around, so you can't go from expensing to then capitalising. And then finally, for this slide, it's worth noting that the decision to expense or capitalise is to be made separately for each area of interest. So, for instance, if you have one area of interest that's in, say, a higher risk jurisdiction, you may develop an accounting policy to expense the E&E spend on this area, but you can capitalise on all other areas if you wish to. Okay, so moving on to the next slide. So if you have elected to capitalise your E&E expenditure, then there are further accounting policy elections that are needed to be made. So firstly, for subsequent measurement of E&E, there's a choice between cost and revaluation. However, due to the very specialised nature of the E&E assets, it will often be difficult to determine the fair value of both any tangible and intangible E&E assets. So consequently, in practice, most entities use the cost model. And also, in addition, because the E&E asset will ultimately be consumed in production. Even if the asset was eligible to be revalued, it's unlikely that this policy would be adopted because it would result in reduced profits during the production phase. So the next election is determining the unit of account, which flows into impairment testing and is similar to the comments made by Kevin earlier when you're allocating your goodwill. So specific to AASB 6, for IFRS 6, this requires an accounting policy to be developed for the allocation of E&E assets to CGUs or to groups of CGUs. However, AASB 6 restricts the unit of account for an E&E asset to being no larger than an area of interest. So AASB 6 will result in earlier impairment or derecognition of the E&E asset than under the international standard. So this graphic here, sorry, just back to the other slide a letter, yeah. So an area of interest can be determined based on a number of options and requires management judgment. The area of interest can be based on geological feature that lends itself to a unified exploration and development effort and can be made up of a number of adjacent geographic areas that have separate licenses attached to them. Whilst it may initially appear attractive to allocate E&E assets to a large area of interest, this can give rise to practical issues. In particular, the decision might increase the frequency with which the asset needs to be tested for impairment and could result in larger charges for impairment. So for example, if you're grouping projects that are close to commercial development with a startup project, this will mean that as each project moves to its commercial development phase, an impairment test of the entire area of interest in which the asset is included will be required. So as you can imagine, those in the startup phase are likely to be impaired at that point in time. So moving on to the next slide. So now I just wanted to look at specific arrangements that are common in the E&E phase, and firstly to look at farming arrangements. So as there's no specific guidance around these types of arrangements, an entity has two options, either to develop an accounting policy under IAS 8 or develop an accounting policy under IFRS 6. And the policy under IFRS 6 would normally be based on a previous national GAAP that contains such guidance. So starting first with AASB 6, so looking at the bottom option of the decision tree, the previous GAAP will generally require that the farmee recognises its expenditure under the arrangement in respect of its own interest and that retained by the farmer, as and when the costs are incurred, and the farmee accounts for these expenditures in the same way as directly incurred E&E expenditure, so either capitalised or expense as incurred. In contrast, if an accounting policy under AASB 108 is adopted, so following the top of the decision tree, and the farmee is farming into an asset rather than a business, it should recognise an asset that represents the underlying undeveloped interest acquired at cost in accordance with IAS 16 or IAS 38, and also recognise a liability that reflects its obligations to fund the farmer's share of the future investment. So depending on how the arrangement is structured, the liability may meet the definition of a financial liability or a provision. And then if, however, the farmee farms into a project that is considered to be a business, which is either a joint operation or results in the formation of a joint operation, the business combination accounting principles of IFRS 3 must be applied. Now looking at the accounting from the farmer's perspective, so if you go on, yes, thank you. So under an accounting policy developed under AASB 6, generally the farmer does not record any expenditure made by the farmee on its behalf. The farmer does not recognise a gain or loss on the farm out arrangement. but rather redesignates any costs previously capitalised in relation to the whole interest as relating to the partial interest retained, and any cash consideration received is credited against costs previously capitalised in relation to the whole interest, with any excess accounted for by the farmer as a gain on disposal. And again, in contrast, if you have a policy under AASB 108, then the farmer is required to de-recognise the portion of the asset that it has sold to the farmee, following the principles of AASB 116 or 138. The farmer will recognise the consideration received or receivable from the farmee, which represents the farmee's obligation to fund the capital expenditure in relation to the interest retained by the farmer. There may be the recognition of a gain or loss on the transaction for the difference between the net disposal proceeds and the carrying amount of the asset disposed. However, recognition of the gain would be appropriate only when the value of consideration can be reliably determined. So if it can't, then the carried party should account for the consideration received as a reduction in the carrying amount of the underlying assets. And the farmer is also required to test the retained interest for impairment if the terms of the arrangement indicate that the retained interests may be impaired. So as you can see, depending on which standard you decide to follow for farm-in, farm-out arrangements, you can end up with quite different results reflected in P&L and balance sheet. Okay, so finally, I just wanted to quickly comment on some common areas where we see divergence in accounting treatment for what appears to be quite similar transactions. So firstly, for royalty transactions, under current IFRS, there is a lack of guidance in how to account for royalty arrangements, and consequently, diverse practice has emerged. The appropriate approach, however, is not an accounting policy choice, but rather an assessment of specific facts and circumstances which would be subject to significant judgments. So some of the various accounting treatments when you enter into a royalty arrangement includes recognising it as a partial sale of the mineral asset, having a financial instrument in accordance with AASB 132, which is relevant when the contract establishes a contractual obligation to deliver cash or another financial asset. Or you could end up with a commodity contract that's outside the scope of AASB 9, but this is only when the arrangement is executed to deliver an expected amount of commodity from the producer's own operation, i.e. you meet the own use exemption. So each of these different examples of how royalty arrangements can be treated will result in significantly different accounting presentations. So it's important to ensure that you understand the specific facts and circumstances and apply judgments appropriately. And then the final area I wanted to address is accounting for stripping costs relevant for surface mines in the production phase. So IFRIC 20 contains the relevant guidance here and provides a list of some of the possible metrics that could be used to determine the appropriate allocation basis for allocating costs between inventory and stripping assets. The common examples are included on this slide. So the most appropriate metric to use will depend on each operation. For example, in operations where there are significant byproducts, the quantity basis will most likely be the most appropriate basis to allocate costs. And IFRIC 20 is very clear that an allocation basis which uses sales value or relative sales value is not an acceptable basis to use. So the importance of selecting the correct allocation basis impacts what is recognised through the P&L immediately and what gets amortised, and the production measure adopted is required to be calculated for each identified component of the ore body. And again, identifying the component requires significant management judgment and is a critical step as the stripping activity asset is required to be depreciated over the expected useful life of the identified component and can result in varying charges to the P&L. So that is a very quick overview of the extractive industry and how it fits in with the strategy discussion around accounting policy choices. And yeah, I think covers the main points that I wanted to address. So I will pass over to Aletta now to take you through leases.
Thank you very much, Ashley. I think it was really interesting to hear from an expert talking about IFRS 6. When you look at these junior explorers and all the mining entities, accounting policy note disclosures are even more important than other entities. And it's always important, but it's even more important. Because as we could see here, so many different options available for farmies, farmers, different options available around what you do with your E&E, costs. So really important to look at those accounting policy notes in order to compare and analyze these financials. And I think you've really articulated that very well. And there were a lot of similarities between what you've talked about and Kevin talked about the life cycle and whether you're still exploring, whether you enter into production, etc. In the different decisions. So thank you very much for that. Kevin, I don't know if you had wanted to add anything on the extractives. I thought it was fascinating.
Oh no, look, it was good. I'll just take one thing out of it. Right at the beginning, Ashley made mention of something along the lines of the choice might not be a good idea for later on, and that just kind of says, what's the long-term game in terms of what you want to see at the end? It might not exactly be the current year or short-term objective.
Absolutely. So it's kind of a very nice segue, Kevin, into the impact of leases on the future. Now, as you know, we've spent the last 3, 4, 5, feels forever, implementing IFRS 16 with our clients here in Australia. And we've talked about, our technology solution, BDO Lead, and outsourcing it to us, and Excel is a problem. And those were all practical considerations and system considerations. What was really interesting when we started to work with clients to implement all this technology, we quickly realized that there are some choices available on transition. And this kind of flagged this whole concept of transitional requirements and how important it is, because there were in fact 3 different transitional methods that had a very different impact on day one, but also over the lease term, so the future. And often entities went for the quick and simple transitional method to save time, and it potentially looked good on their balance sheet. But when you overlaid what this will look like over the next 10 years, they quickly said, hang on, don't want this. It might be quick, it might be fast, the balance sheet might look okay, but don't want the impact on P&L in future. However, some of our other clients said, hang on, our P&L is actually very strong. It can deal with the negative impact in future. For other reasons, we would rather, improve the balance sheet now. So we really dealt with clients at both ends of the spectrum. And in the end, it was not simplicity that won the argument at the board level. It was not speed or simplicity. In the end, the board looked at the financial consequence of each transitional method before they picked an appropriate transitional method. And, that's when we started to think, hang on, we've got issues here. So I think it comes back to what are the key drivers around lease accounting. Now, obviously, we've moved on. We're now heading towards 30 June 2021, the second year where we are reporting on leases in the balance sheet under IFRS 16. But there are still decisions that we make on a daily basis around leases that would impact whether we are strengthening our balance sheet or whether we are managing the impact on profit and loss. So if you look at strengthening the balance sheet, if you want to strengthen your balance sheet, you could say, I could do that by limiting the recognition of lease liabilities. I don't want these big lease liabilities because it's an issue for covenants. It's got an issue for my debt equity ratio. For various reasons, I don't want so many lease liabilities. Or you could say, I want to strengthen my balance sheet by increasing the recognition of right of use assets. I want to show that we've got all these assets available that's working for us, that's going to generate profit in future. So unfortunately, if you look at the balance sheet, you cannot really have the right of use asset without the lease liability. They go hand in hand. But it's also important to understand the relationship between the two, because quite often, if you want to strengthen your balance sheet and you start with this asset, right of use asset and lease liability, the asset is depreciated much faster than the lease liability is removed. This is generally, all right? And therefore, maybe on day one, you've got this nice asset and liability, and yes, they equal out, but over time, you're going to have this lease liability exceeding the right of use asset for many years to come. And do you want that on your balance sheet, right? So there's consequences there. It's linked. The other big thing is some organizations would say, we are worried about the impact on our P&L. Now, this is an interesting one because in the olden days, we also had, Kevin, it's just 2 years ago, relax. Olden days is 2 years ago. In the olden days, all these lease payments did eventually go through the P&L, but it went through the P&L on a straight line basis, in a somewhat even basis, right? However, now the right of use asset might be depreciated evenly, but the lease liability leads to an uneven unwinding of an interest expense because initially you're paying more interest than capital. So if I talk about managing the impact on the P&L, we cannot avoid the fact that there will be an impact on the P&L. The issue is, will that impact be somewhat straight-lined, or will it be an uneven unwinding? And we know that finance people, CFOs, when we communicate to the market, there's a fair expectation that there's an somewhat even outlook and hopefully a somewhat increasing even outlook. So I think that's the kind of things to think about. Where is the focus? Strengthening the balance sheet or managing that impact on the P&L? Now, you might say, Aletta, we understand transition because you talked about it forever and we're sick and tired of it. So I'm now thinking, okay, 2 years later, I still have this problem managing the balance sheet or strengthening the balance sheet or managing P&L. What levers can I now pull from a leasing perspective that would have an impact on that? And do you realize that it has an impact? By the way, can you model the impact? So you make real decisions here or appropriate decisions. So it's little things. I reread my favorite standard to come up with a few of these. In the standard, they come up flagged as practical expedience. Sometimes they come up as flagged under the word you may do this or you don't do it. All right. So you have to read carefully. They don't jump up and say there's options here. But if you read carefully, there are options available. So you could exclude short-term leases when you recognize right of use assets and lease liabilities or not. You can put it in that lease liability in that right of use asset, but then there would be a consequence for P&L. You could exclude leases of low value assets or not, right? And don't just think what is simple, what is easy. Think about the impact on the financials. You could include non-lease components in your right of use asset and your lease liability. So it will bump up the size of the right of use asset and the lease liability because it's lease components and non-lease components. So non-lease components would be you leasing a property, but you also paying for security, for maintenance, for cleaning. So if you group it all together and you put it in the right of use asset and lease liability, it's bigger on the balance sheet. However, how will that play out over the lease term? Let's think about that. But you've got a choice there. After you've initially booked your right of use asset, in certain situations, not always, in certain situations, you have a choice around subsequent measurement, whether you use the cost model or the revaluation model. The fifth one is around rent concessions. And there's recently been another change to that rent concession arrangement, and we'll discuss it next month. But on rent concessions, again, I was surprised how clients had such a different view. If you've received a rent concession and you've taken the cash benefit, okay, fantastic. Now, how are we going to tell the story? Are we going to book that benefit in P&L immediately? Or choice, can we spread it over the remaining lease term? All right, so if you've qualified for those special rules around rent concessions, you've got a choice to use the special rule or walk past it. All right, so again, are you looking benefit now or are you looking benefit in future? Some clients have said, Aletta, we need the benefit in our P&L now. Others have said, everybody knows financials are looking bad. Don't take the benefit now. It's COVID. Let's spread it over the future lease term. So what do you want to do? It's a choice. The last one, the first five is things have already been agreed and it's now choices you've got. The agreement is in place. You choose how to account for it. The last one is how do you negotiate leases? So it's a little bit more open-ended. If you still have the ability to negotiate new lease arrangements, and under COVID, many landlords and tenants are renegotiating agreements. And I appreciate that there are commercial reasons why you enter into certain arrangements. But you could potentially model, and I'm working with a client where we are modeling different proposals the landlord put to them. And we are modeling cash flow and tax, and we are modeling accounting. And that is, if you've got a new agreement that has fixed payments with fixed increases, what does that do to your balance sheet? And what does that do to your future P&L? As opposed to having payments that are variable payments, maybe totally variable, or maybe a bit variable, or based on sales, or maybe you've got fixed payments, but they don't have fixed increases. They have variable CPI increases or market reviews. Again, different accounting treatment because your right of use asset and your lease liability is focused on fixed payments or in substance fixed payments. So again, the way you negotiate this arrangement has commercial consequences, absolutely. However, it's useful information to know what the accounting consequences are as well. So I thought I'll throw that in there as well. So what levers can you pull? The other thing that I thought, Aletta, just be a little bit careful as well. And I want to say to our attendees, please be careful here. There are certain things that you cannot play with. It's a matter of facts and circumstances. And I want to mention lease term. If you enter into a month-to-month lease because you want to use the short-term lease exemption, that is not a great strategy because the standard looks really at the substance. If you've been in this property for 10 years and if you've incurred significant improvements to the property and furniture and fit out, etc., leasehold improvements, and you're going to stay there for another 20 years, the fact that legally you've got a month-to-month lease, we will just walk past that and still book a right of use asset and a lease liability for 20 years. So lease term, you have to be careful. You know what the standard says. It's not the legal lease term. We've got a fancy definition for lease term in this accounting standard, so hard to manipulate it, right? And not to be recommended. Holdover period's the same thing. If both the lessor and the lessee has an option to terminate, if we go into holdover, there's factual things that we take into account. We consider economic reasons to stay or go. So lease term, be very careful. All right, it's hard to get around those requirements, and we shouldn't try and get around those requirements. Incremental borrowing rate. Now, this is another interesting one. Corporate finance come up with an incremental borrowing rate. That's the way we should do it. Maybe they come up with a range, and maybe it's an acceptable range. And now you have a little bit of a choice. Do you want to go to the lower end of the accepted range or the higher end? Both will be accepted. A middle point would be accepted too. And therefore, again, think carefully. If I go for a high end of the range, I end up with a low right of use asset or a lower right of use asset and a lower lease liability. But when I unwind the interest expense, it has a big impact on my P&L in future, and vice versa. So obviously, you can't manipulate incremental borrowing rate. However, I have seen situations where a range would have been acceptable, and then some entities go for the lower end and some go for the higher end of that range. Do you know the difference it's going to make? And so be careful. And then the last one is when you renegotiate leases, please be careful around the timing. I'll give you an example. If you currently use a property and the lease is expiring on 30 June, and for commercial reasons, and this is an important property for you, you want to stay in that property, you renegotiate a new lease and you actually lock it in March. But obviously this new lease, which is a brand new separate legal agreement, will only commence or continue from 1 July onwards. Please remember, from an accounting perspective, the new lease is seen as a modification of the original lease. And as soon as you've agreed to it, we will book the impact. We have to recognize the impact, the right of use asset and the lease liability, and that already will be reflected in 30 June financial statements. Right, so I think that a lot of people are thinking if I can have a contract that says it's commencing on 1 July, but it is a continuation of the use of a property that I'm already using, that they can delay the recognition of that new liability till 1 July. And it's interesting. Because if you enter into a new lease, a brand new lease of a brand new property, if you sign it today and the lease actually only commences and you start to use the property fair dinkum on the 1st of July, it wouldn't be in your 30 June financials. All right, so we have to think about this a little bit and be aware that timing of signing the agreement, if it's a continuation, could trip you up, right? So just be aware of these. So just things to think about. Kevin, and it comes nicely back to all the decisions you've talked about between balance sheet and P&L, or I thought so. Who would have thought that leases can create all this excitement? I suppose what we are seeing in our client base, and Kevin and I and Ashley as well, we are seeing more and more clients saying, finally, we accept we have to apply IFRS 16. It's a pain, but we accept it. Let's now start to think, what is the best way to deal with it, and we need a technology solution, and we have to make smart decisions about it. All right. So, Kevin, unless you and Ashley have something to add there, I'm going to move on to the last bit around assistance. We are providing a lot of work helping clients to be audit ready. So CFO services where they ask us to help to get reconciliation sorted. My team is working on a big project to work on intercompany loans within a big group to make sure we've got it all reconciled before the auditors arrive, etc. So we can help you to be audit ready, more than just IFRS work, any kind of accounting work. Our team happy to look at that. We also help a lot of our clients that are currently or previously done special purpose financials, do an assessment, what do they need to change to go to general purpose financials. We also do a lot of work with entities who want to IPO, and they need an IFRS health check. If we need 3 years of IFRS compliant financials to IPO, let's get ready before the auditors arrive. We've come up with our 5 steps for a successful transition to general purpose financials, or you can also say 5 steps to a successful transition to IFRS for IPO purposes, similar steps. Earlier I've said we've got the virtual workshops kicking off tomorrow, starting with business combinations. And then we've got our IFRS leaders across Australia, and you'll see that Lynn is the leader in Adelaide. So please reach out to any of us if you've got any questions or would like to discuss anything, looking for support. And please, if you're looking for somebody in corporate finance and R&D, whatever, we will put you in contact with the right person. We know what our limitations are, but we would love to introduce you to the right and appropriate partners. And then also our bigger team, if you want to work with any of them, you'll see we've got from a senior consultant right through to a partner, various people that can work with you. Finally, Ashley and Kevin, thank you very much as always for sharing the joy and the fun. Lovely to see you guys. Thank you for the experience and the knowledge you share with our wonderful clients. And to our clients, thank you very much. Enjoy the day.
Thank you, everyone. Bye.
Thanks. Bye.
Thanks, Kevin.